Today we will be discussing about capital structure using Lyons solar technologies as an example. Modigliani and Miller are two professors who developed a capital structure theory known as the M&N model. This model argues that it's no use to increase debt to maximize shareholder wealth because in the end the capital structure won't affect the value of the firm. The M&N model has two propositions. Under Proposition 1, it simply says that the value of a leveraged firm is equal to the value of an unleveraged firm. Proposition 2 states that the cost of equity rises with debt, and that's because the risk of equity rises with debt. Under these two propositions, the M&N model assumes no taxes. Here is an example, and we will assume that firms U and L are in the same risk class, and that both have earnings before interest and taxes of $500,000. Firm U uses no debt financing and has a cost of equity of 14%. Firm L has $1 million of debt outstanding at a cost of 8%. We also assume no taxes. Under Proposition 1, the value of a leveraged firm is equal to the value of an unleveraged firm. Both firms have a market value of $3,571,429. Since firm L has $1 million of debt outstanding, we calculate its equity to $2,571,429. Under Proposition 2, it states that with every increase in the debt-to-equity ratio G over S, the return on equity will increase, and we can see this on number 3, which is 16.3% for firm L. The proposition mentions that WACC will always stay the same regardless of the capital structure and should therefore equal the cost of capital of an unleveraged firm. So we can see this on number 4. Both firms have a weighted average cost of capital of 14%. Here, we will assume that both firms are subject to a 40% corporate tax rate, using the data previously used as well. First, we have to point out that under taxes, Proposition 1 changes, and it says that the value of a leveraged firm will increase as debt is added. Proposition 2 assumes that the expected return on equity will no longer increase as fast because taxes are being considered. In this table, we could see that the value of both firms are now much lower, and that's because the 40% tax rate decreased income by 40%, and therefore lowering the values by this amount as well, and as a result, lowering the value of firm's L's equity. Everything else pretty much stayed the same. Miller later added personal taxes into the proposition, making the formula evolve into the one you see here. Now we suppose that investors are subject to the following taxes. TD equals 30% and T of S is 12%, where TD is the personal tax rate on debt income and T of S is the personal tax rate on stock or equity income. When we use Miller's model to try to find the value of a leveraged firm, we end up with this formula. We could say that the value of the leveraged firm will increase by 25 cents for every $1 increase in debt, or increase $25 for every $100 increase in debt. If we compare Miller's model to the M&M model assuming taxes, we could convert Miller's model to only incorporate corporate taxes. The equation then would say that the value of the leveraged firm will increase by 40 cents for every $1 increase in debt, whereas in the previous, it only increased by 25 cents. So we could see that personal taxes have a huge impact on the gains from the use of the leverage. The M&N model under no taxes recommends companies to use 100% debt financing, since debt has no effect on the value of a firm. Under the M&M model, assuming taxes, it also suggests to use 100% debt, since the value of a firm increases with every increase in debt. The Miller model incorporates personal taxes, which lower the value of debt financing, and it also suggests to use 100% debt, but companies would rather use a 40% debt ratio. Under Proposition 1 for the M&N model, assuming taxes, it does not assume growth. So therefore, if firms U and L are growing, it means that they are not following the model, which could be a violation. We could see that on step 3. The value of the leveraged firm is 4,028,571, which is significantly larger than all of the previous calculations, and this is due to a larger tax shield calculated also on number 3, which came out as 457,143. If firm L's debt is risky, it could mean that there is a higher probability of default by that company. Here, L's operations is 4 million, which is the value of its debt plus equity. The debt consists of a 1-year coupon bond with a face value of 2 million, and the volatility is 0.60 with a risk-free rate of 6%. This situation would be considered a call option because if the firm brings in less than the 2 million that they owe, they will default. But if it brings in more, they will pay off the debt. Therefore, the call option can be valued using the Black-Scholes option pricing model. On the top left is the equation for finding the value of a call, denoted as C equals. On the right are the calculations. Since the value of the equity is 2.196 million, roughly 2.2 million, it's more than the debt on the bonds, so they will be able to pay off the debt, keep the firm, and obtain a yield on the bonds of 10.89%. Lastly, we will compare the value of L's equity for volatilities between 0.20 and 0.95. From this table, we could see that as volatility increases, the equity increases, but debt decreases. This would entice managers to take on more risk in order to increase the value of a firm's equity, which will decrease the value of debt. Bondholders, on the other hand, would probably demand a higher rate of return to compensate them for a higher risk.